This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Here's something most beginners don't realize. Every single candle on a chart is telling you a story. It's showing you exactly what buyers and sellers did during that time period, who was in control, who panicked, and who won. Once you know how to read that story, you stop guessing. You start seeing the market clearly. You'll look at the same chart everyone else is looking at, and you'll see things they don't. That's what this lesson is about. We're going back to the very beginning, the foundation of price action trading. Stick with me for the next 10 minutes, and candlestick charts will never look the same again. Candlestick charts weren't invented on Wall Street. They go back over 300 years, to Japan. A rice trader named Munehisa Hama figured out something that Western traders wouldn't catch on to for another 2 centuries. Price moves aren't just about supply and demand, they're driven by emotion, fear, and greed. Hama started tracking those emotions visually on a chart. He developed a system of recording price action that captured not just what happened, but how it happened. The shape of each candle told him whether the market moved with conviction or hesitation. That system became the foundation of what we now call technical analysis. For nearly 300 years, candlestick charting remained almost exclusively a Japanese technique. It wasn't until 1991, when a trader named Steve Nissan published his landmark book, that Western traders finally caught on. Within a decade, candlestick charts became the global standard. Today, every major bank, hedge fund, and professional trader on the planet uses candlestick charts. That tells you everything you need to know about their value. You're not learning some new retail trick. You're learning a tool with over 3 centuries of proof behind it. The same tool that professionals use to move billions of dollars in markets every single day. Now, let's break down what a candlestick actually is. Every single candlestick on a chart contains exactly 4 pieces of information: the open, the high, the low, and the close. The thick middle part, called the real body, shows you the distance between where price started and where it ended. This is the core of the candle. It tells you the range the market committed to during that session. The thin lines sticking out above and below the body are called the wicks, or shadows. The top wick shows how high price pushed during that time period, the maximum the buyers could reach before getting pushed back. The bottom wick shows how low price fell before recovering, the maximum the sellers could press before losing control. 4 numbers, 1 powerful visual. That's the whole thing. Now here's the color code. If the candle closes higher than it opened, it's green. That means buyers were in control. They took price from the open and pushed it higher by the close. If it closes lower than it opened, it's red. Sellers dominated. They pushed price down from the open and held it there. Simple as that. Green means buyers won. Red means sellers won. The body shows you by how much. The wicks show you the fight that happened along the way. Not all candles are created equal. The size of the body and the size of the wicks give you critical clues about market conviction, about how strongly one side dominated. A long body means strong conviction. A big green candle tells you buyers were aggressive. They pushed price up hard and held it there through the entire session. A big red candle means sellers dominated from open to close. These are momentum candles. When you see one, it's telling you that one side showed up with real force. Respect that signal. Short bodies, sometimes called spinning tops, tell a completely different story. When the body is small, neither buyers nor sellers could take control. The market is undecided. That indecision matters, especially when it shows up after a strong trend or at a key price level. It could be the first sign that the trend is losing steam. Now the wicks. A long upper wick means buyers tried to push price higher, but got rejected. Sellers came in and pushed it back down. That upper wick is a scar. It marks the level where the bulls ran out of steam. A long lower wick means sellers tried to drive price down, but buyers stepped in and reversed it. That lower wick marks the level where demand overwhelmed the selling pressure. Those rejection wicks, that's where reversals begin. In later lessons, you'll learn to spot specific patterns built around these rejections. But for now, just remember this: the longer the wick, the stronger the rejection. And rejections at important price levels are some of the most reliable signals in all of trading. Before we continue, Quick shout out to today's sponsor, ResumeZenith. If you're trading to build a better future, you still need to handle the present. ResumeZenith is the site I personally recommend to anyone job hunting or leveling up their career. Clean, professional resumes built fast. Check them out at ResumeZenith.com. Links in the description. And if you're getting value from this lesson, hit that like button, subscribe to the channel, and turn on the notification bell. We drop new lessons every Sunday, Tuesday, and Thursday, and the next lesson covers the 5 most powerful single candlestick patterns. You don't want to miss it. Before candlesticks became mainstream in the West, traders used bar charts. Bar charts show the same 4 prices: open, high, low, close, but they display them as a thin vertical line with small horizontal ticks marking the open on the left and the close on the right. The problem? They're difficult to read at a glance. Your eye has to work to decode the information. Is that tick on the left the open or the close? Is the move up or down? You have to think about it every single time, and in fast markets, that processing delay costs you. Candlesticks solve that entirely. The filled body, the color, the shape, your brain reads it all instantly. You can scan a candlestick chart and within seconds know where the market has been bullish, where it's been bearish, and where it hesitated. Green up, red down, big body strong, small body weak, long wick rejection. Your eye processes all of that without conscious effort. That speed of recognition is a real edge in trading. Faster pattern recognition means faster and better decisions. That's why professional trading desks moved to candlesticks and never looked back. Both chart types contain identical data. The only difference is how fast your brain can decode it. In trading, speed and clarity directly affect decision quality. Candlesticks win on both counts, every time. Let's lock in what you've learned. Candlestick charts originated in 17th century Japan and are now the global standard, used by retail traders and professional institutions alike. Every candle shows exactly 4 prices: open, high, low, close. Nothing more, nothing less. The real body is the thick rectangle. It shows the range between the open and close price for that session. The wicks show the high and low, and they mark the rejection levels where price was pushed back. Green candle means buyers won. Red candle means sellers won. Long body equals strong conviction. Short body equals indecision. Long wick equals price rejection at that level. That's the foundation. Every pattern, every strategy, every advanced concept you'll learn in this series builds on what you just learned right here. Master this, and everything else starts to make sense. Time for your homework, and I mean it. This is where the real learning happens. Step 1. Open a free charting platform. TradingView is the industry standard and completely free. Links in the description. Step 2. Switch the chart display to Candlestick View. Find the chart type selector in the top toolbar and select candles. Step 3. Pick any asset. A stock like Apple or Tesla, a crypto like Bitcoin or Ethereum, a forex pair. The choice doesn't matter. Candles work identically across every market. Now here's the real exercise. Spend 10 focused minutes just observing the candles. For each one, ask yourself, who won, buyers or sellers? How strong was the conviction? Was there a wick rejection? Do that every day this week. You'll be surprised how quickly your eye starts to see patterns. And if you want this lesson as a clean, downloadable PDF, just drop your email at candlelogictrading.com and we'll send it right to you. In the next lesson, we cover the 5 most powerful single candlestick patterns, the specific shapes that experienced traders watch for every day. Same clear, no-nonsense breakdown. You don't want to miss it. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. That's it for today. Read the market, own the trade. I'll see you in the next one.